So for them, the best course would be a slow kind of deflation of the bubble, a restructuring of the economy, a reset, and then job growth. They're mostly going to focus on job growth, not the stock market. The stock market benefits the owners of financial assets more than the average citizen in the U.S. and really, frankly, anywhere. So that's the plan. It's going to take time, and it's not going to be easy, but I think it has to be done because since the great financial crisis, the U.S. manufacturing base, which was already hollowed out, got even further hollowed out, and it's a tale of two cities. It's the very poor get government benefits, and the very rich prosper from the government spending that flows into the stock market. And so this is a reset of a sort, not the great reset that other people were talking about, but a reset to restructure towards America.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Edward Dowd. So Edward is the founder of Phinance Technologies and author of Cause Unknown. So Ed, thanks so much for coming on the podcast today.
Anthony, great to be here. Thanks for having me on today.
No problem. We're looking forward to your perspective because I think today we were just talking before, it's sort of the flash crash of Trump saying he doesn't care about markets, but I'm sure we'll get into the intricacies of what's happening and what's going to happen in the future. But I would like to just start very, high level. What are you currently seeing in the economy and markets?
Yeah, sure. So it's important to note a call we made in 2023. We were looking and forecasting a recession beginning around the end of 23, beginning of 24. And my partner, Carlos Alegre, is a PhD physicist and he's also got a PhD in finance. He's worked at a bunch of hedge funds, Winton, and he lived in London for a time. He's in Portugal right now, but he's developed early cycle indicators, traditional fundamental leading indicators that anticipate the U.S. economy. And everything was flashing for a recession for the end of 23 and 24. And we weren't the only economists calling for that or market participants, and it never came to pass. And so we had to ask ourselves, have the fundamentals of economics changed? Is there something new going on? And we kind of, after some time, figured it out. What really happened and floated the U.S. economy compared to the rest of the globe was massive fiscal dominance in the form of deficit spending. We were running the last 2 years 8% deficit to GDP, which is crisis level spending. In the great financial crisis, we were running deficits of 10% at the extreme. So you have to ask yourself, what was the crisis? We've determined the crisis was getting the Biden regime reelected. And their massive spending created what we call a new economic variable, the elephant in the room. And it was mass immigration coupled with government jobs hiring. So the U.S., literally the private sector economy was in what we would call recession, but the overall economy was floated along by massive government spending. That leads to the election with Trump. Trump won, and if you want to know why he won, forget all the noise you hear. There's really one reason. It was the economy. We have statistics that show that. So basically, going into the election, real wage growth in the U.S. was minus 2%. That happened in 1980 election under Ronald Reagan. He had minus 2%. He won in a landslide. And Bill Clinton in 92 also had minus 2% real GDP wages, and he won. And his campaign advisor, James Carville, famously said, "It's the economy, stupid." So the average American was feeling that their life had gotten much more difficult under Joe Biden. And that's primarily why Trump won. And Trump's promises and pledges was to stop illegal immigration, to cut government spending or investigate it, and to redirect the economy from fiscal dominance back into the private sector. So essentially what we're seeing now is the unwinding of an unsustainable Biden policy. It was a sugar high, and it was very unproductive debt that we added. It was government jobs and legal immigrants. And so you're seeing the effects of that. We put out a report at the beginning of this year highlighting that we were wrong in 23, 24. We figured out why, and we figured out what's coming this year. And it looks like we're predicting the danger of a deep worldwide recession, and it's going to be led by the housing sector and the unwind of this spend. That's it, kind of in a nutshell. And we put out the report on January 9th, and on the 10th, U.S. Treasury bond yields, the 10-year and the 30-year peaked and have been going down ever since. So, was that due to our report? Absolutely not. Our timing was just good. I mean, we're not going to take credit for that, but it seems like this is happening a lot faster than we anticipated. We were expecting our call to be kind of manifesting itself sometime in the June, July timeframe. It looks like it's starting to manifest now, and the numbers are starting to go our way.
Yeah, okay, a lot to unpack there. So how is it possible that I guess there was such a large deficit and people were struggling? Was it just because it was very concentrated, as you said, into the government workers and basically, legal migration, I guess people who contractors for the government? Was that the issue, was being funneled into that direction rather than the broader economy?
Yeah, so what we're finding, so we suspected, and we talked about it a little bit in our report, but we were even shocked at what's Elon Musk's DOGE, Department of Government Efficiency, is finding in terms of the NGO system. So if you think about it, so normal net legal migration in the U.S. is about 1 million a year historically. Over the prior 4 years, we let in 10 million that we know about. Those were 10 million official border encounters, so 10 million official illegals. You could probably suspect that not everybody was encountered at the border, so it could have been 10 to 15, maybe even higher. And this was a purposeful government operation. There were NGOs involved. So it's not hard to do some back of the envelope math. We don't have the exact evidence, but I think this math is right. So one illegal coming from Central America, money has to go to them to get them to the Darien Gap, through the Darien Gap to the Mexican border. Then they get over the border. An NGO and other organizations facilitate their transportation into the U.S., accommodations, food, shelter, that kind of thing. So the all-in economic cost of each illegal immigrant, it's not hard to fathom. It could be anywhere from $25,000 to $100,000. So the spend on the illegal immigrants realistically could have been anywhere from $500 billion to $1.5 trillion. That's kind of our math. And the economic impact of an illegal alien coming in getting stimulus is very good short term. These people, they hold up the housing market because they get accommodation in the form of rent, and they also get stimulus or aid from NGOs and or the government directly, and spend that immediately into the economy. Some of these people found jobs in the U.S. We suspect about 2 million of them found jobs. The other 80% of them are not employed. And when Trump got elected, in November, there were self-deportations, and we saw that in the new tenant rent data, which plunged in the fourth quarter. So there was an immediate impact of people self-deporting. Now the border encounters are basically virtually collapsed. It's not happening right now. So the flow is stopped and reversing, and we think that's having a direct impact on the economy. The NGO system seems to be on pause. There's a lot of frozen payments that Trump has frozen going out to these NGOs. So it's having an immediate impact on the economy, we believe, and we'll know more as we get more data.
And what do you think the reason behind the Biden administration sort of pushing down this direction? Was it economic? Was it a moral duty that they thought they had? Do you have any perspectives?
Well, this is all speculation, but I think the most the greatest agreed upon narrative is to change the political face of the U.S. and import future Democratic voters. So that's one. There could also be a case made that it's a replacement operation to bring in cheap labor that doesn't have the same expectations of retirement that every other American has. So it's kind of it could be a host of different reasons, but it was definitely an operation. It was not moral reasons are ridiculous. I mean, this crisis down in Central America. There's crises around the world all the time. And, there was a decision made, purposeful decision made to bring in 10 million plus illegals over the course of 4 years. We've never seen this kind of immigration into the U.S. in these kind of numbers. It's basically a new economic variable, and that's what blew up everyone's economic models. And if you look at the GDP of the U.S. compared to the other major economies, our GDP was like a shining star the last 2 years. German economy's not doing well, China's not doing well, Japan, France, the Europe bloc in general, South Korea. These economies have been not doing well compared to us. So that kind of also drove a lot of foreign assets into our markets. Our stock market has never had this amount of foreign ownership. So, if you think, you could call the economy for the last 2 years fraud, or you could call it unsustainable. It doesn't matter. It's going the other way, and the shining GDP growth of the U.S. is going to reverse.
And then this doesn't sound like it's very popular from a political perspective. So why would Trump? Why is he doing this? Is this to sort of rebalance the economy? Prioritize Mainstreet over Wallstreet. Is that where you see the direction of it going?
That's absolutely what they're signaling. That they're not being cryptic about it. Scott Bessent, the Treasury Secretary, has said this often, that he's focused on the 10-year yield, which means he wants interest rates lower. Interest rates will go lower one of two ways. The Fed starts lowering interest rates, or the long end of the bond curve anticipates a slowing economy, and rates will go down. In fact, look, recessions are nothing to be too scared of. They reset everything. Rates will go down. That'll reinvigorate the economy, 18 months later. It's a cycle. So we're going into a cycle that had to happen. And as this cycle unfolds, they're going to try to restructure the economy away from government dominance to private investment. And you can see a lot of Trump is announcing a bunch of deals with different countries to bring manufacturing back to the U.S. So they say they're going to do it. They don't care about the stock market, which is at absurd valuations. Warren Buffett has been accumulating the largest pile of cash on his balance sheet ever known to him. And he was early, but he's anticipating bargains in the stock market going forward. So a recession had to happen, and it's going to happen, and it's not the end of the world. But Trump is a one-term president, and he wants to have his legacy that he restructured the U.S. economy. People on Wall Street won't like it, but Mainstreet people are already in pain. Their biggest risk during a recession is losing their job. That's their biggest asset. So there'll be some job losses, but this is kind of a course correction that we've been seeing since the great financial crisis. This constant money printing and government spending, not by just the U.S., but all governments across the globe. And this is also a hangover from the COVID warlike spending that every government did. We spent trillions of dollars during COVID and inflated the money supply. That's when real inflation really started to happen, when the Federal Reserve printed 35%, added 35% to the money supply, super quick. It was a war. If you look at the numbers, it's like World War III happened.
Yeah, and it's as you said, it needs that balancing. And I guess if we look at the actions that are taking, it's got reduction in government spending, hopefully reduction in regulation, and then from there in 2 years' time, the economy's rebalanced, and I guess they're going to try and push through tax cuts to then, I imagine, try and get everyone excited for not Trump, but whichever Republican comes into play in 4 years' time to be re-elected. Is that sort of what do you think it's that long term, or is it more just rebalance, one and done?
Well, I think it's going to take time. So first of all, there's the adjustment. There's a valley, but before the policies that Trump and team want to work, and it's not a given that they work. I mean, there's risk here. So you're going to get a valley, an economic valley, a dip, asset prices reset. And again, it's not going to happen overnight. This is a process. And if people want to go back and look at what happened in the 2000 tech bubble, the stock market went down 50%, but it didn't happen all at once. It happened over a 2-year period. So for them, the best course would be a slow kind of deflation of the bubble, a restructuring of the economy, a reset, and then job growth. they're mostly going to focus on job growth, not the stock market. The stock market benefits the owners of financial assets more than the average citizen in the U.S. and really, frankly, anywhere. So that's the plan. It's going to take time, and it's not going to be easy, but I think it has to be done because since the great financial crisis, the U.S. manufacturing base, which was already hollowed out, got even further hollowed out, and it's a tale of two cities. It's the very poor get government benefits, and the very rich prosper from the government spending that flows into the stock market. And so this is a reset of a sort, not the great reset that other people were talking about, but a reset to restructure towards America. And look, this is going to be painful for other countries around the globe because a lot of their senior officials have been benefiting from the current order of things.
Yeah. So do you see this being a shift? Maybe this is too extreme, but away from capital to labor. Is that sort of what you see happening?
Well, it has to happen because let's say we decided not. Let's say Trump didn't win and Kamala Harris was in there, and they continued to run these deficits that only benefited the DC apparatus and the well-connected in corporate America and the rich. Eventually, you get an unstable situation where you do get to situations where unimaginably in the U.S. Civil War, revolution. If you look at what happened in the Arab Spring, when the cost of living consumes just basic needs, consume 50% of your income, that's when populations get agitated. Every intelligence agency knows the magic number, and so every government is fighting against their own people in that they try to keep a nice balance of keeping the show going without getting the peasants too riled up. And so that's the risk for the current course of action was political and social unrest. Trump is trying to reverse course to make the society in the U.S. civil society more evenly spread. Again, it's not going to be easy. That's what he says he wants to do. We'll see if that gets implemented. But at bare minimum, there's going to be asset price deflation and a recession, which is not a bad thing. If you're someone that doesn't have a lot of stuff and you have a little bit of savings, you can enter into the market or maybe be able to buy a house cheaper. I mean, this is a kind of a shift from the baby boomers' wealth to the millennials who are priced out of the housing market and don't have a lot of stocks.
Yeah, which is definitely I think needs to happen if you look at all the statistics. But it sounds like you don't think this will be good for other countries. So they haven't had any economic growth because they haven't been had this large, extreme migration and then extreme government spending. But even now, you don't think they're going to be able to recover if the US goes through this path?
Well, I think, look, you're already seeing Germany announce massive spending. So, other countries are going to react. It's kind of like game theory. So the U.S. goes into a recession, it'll drag the rest of the world down, and then other countries will react in their own best interests. And there's a lot of turmoil right now in regards to the Ukraine war, NATO, the Europe alliances. There's a lot of moving pieces. The U.S., quite frankly, because we're the consumer of last resort, has a lot of, and the U.S. and we are the reserve currency, we have a lot of leverage against some of these trading partners. And some of them, and that's why Trump is going to use tariffs as a means to bring people to the table to renegotiate deals.
Yeah, and I guess then you get, maybe before I go there, so it sounds like you don't think the US is going to experience inflation. It's going to sort of be more maybe not deflation, but a lower inflation environment with bonds. Yields coming down.
So if we're correct, there'll be a period of disinflation, maybe a brief deflation scare, but what's going to happen, and we suspect it will happen, and we talk about it in our report. We basically say we don't know what the policy response is going to be. So when we see the policy response, what will it be? Will it be more massive QE from central banks like the Federal Reserve? Will it be yield curve control? Will it be fiscal stimulus? So we'll have to see. So we suspect, bankers, it's inflate or die. Deflation and disinflation, unless it's slow and steady, they don't like it. So we suspect after we see the policy response, which will come, it'll be late, but it'll come. We suspect it'll be another round of inflation. So we're kind of in this disinflation, deflation, inflation roller coaster where you need to constantly create credit, but then eventually you got to then stop the credit flow because inflation's running too hot, and then rinse, repeat. It's a cycle. It's a cycle of stagflation. We think. Again, we don't know until we see the policy response. But what we're pretty confident in is that we're going to get slower GDP growth, risk off selling in risky assets, and a flight to safety like government bonds, the U.S. government bonds.
Yeah, and that helps because there's lots of debt sort of rolling off this year as well. So if it's a lot harder a lot of that was refinanced during COVID. It was sort of very low rates. So then now if you have interest rates coming down, that could potentially benefit the refinancing of this economy for another 5 years.
Yeah, correct. So Secretary Yellen issued a bunch of the U.S. debt on the front end of the curve, which a lot of people criticize because that's kind of what banana republic third world countries do. They issue very short-term financing because that's only because that's all they can do. This will give Scott Best, and if a recession does manifest and yields come down, which I suspect they will, and they're in the process of doing that, that'll give them an opportunity to term out a lot of the debt into longer term paper. And there'll be demand because in a recession, there's a flight to safety and a reallocation out of risk into safety.
Yeah, and does this sort of give Powell no option but to cut rates, or do you think it's going to try and sort of push back?
Well, look, he's going to follow the data, and the Fed. A lot of people thought that the Fed cut interest rates last summer. They've already lowered interest rates 100 basis points. A lot of people thought that was a political move. It actually wasn't. The yield curve was starting to signal that they were behind the eight ball. The 3-month T-bill started to go lower than the Fed funds rate. And typically the money markets lead the Fed. Right now, the 3-month T-bill is still not really signaling that the Fed's going to cut next week. But I suspect the Fed will be chasing this all the way down. And Trump and Bassett will get their interest rate cuts, but not because they told Powell to do it. Powell's just going to do it because the economy is going to lead him, the data will lead him in that direction. We think they'll, Fed funds will settle somewhere between 2% and 3% when this is all said and done.
Okay, so it does sound like it's sort of the end of the everything bubble, or do you think it's just more a delay for a few years until sort of things go back to where they are? Do you see this potentially being a massive secular shift away from what we've experienced the last 10 years?
That's hard to say. Well, that's too far out there. And look, I'm not one of these gloom and doomers that's going to say the world's ending and all that. We're seeing a recession. Recessions have happened. They're not scary. There's a lot of good policies being proposed by Trump to restructure the economy. In our report, we're not calling for a systemic crisis like the great financial crisis. If that happens, we'll call it out in real time. And that's when it gets tricky. If we start to see, basically daisy chain effects of bank failures spreading fast. So far, that hasn't materialized. There was a bank scare in 2023. We had a bunch of big bank failures here in the U.S., but the Fed implemented the long-term funding program for these banks that kind of stabilized the outflows of deposits. So they did their job. They prevented a bank run. But the problem now is that was due to duration risk in their portfolio, where the Fed was at 0 for 14 years and went to 5%. That caused some of the banks to be upside down on their held to maturity safe securities like treasuries and whatnot. that's easy for the Fed to cover. What they're not going to cover is credit risk, and there's a lot of credit risk. So we're going to see some bank failures as long as it doesn't, turn into a panic. I think we get through this, and we need a cleansing. The question is this the big one, the end of the everything bubble? And again, I can't call that, but there's a lot of risk right now.
Okay, so yeah, because it's interesting because I hear people say, oh, credit yields are very aren't very large at the moment. That there isn't too much leverage in the system. I guess market in I guess stock market, etc. Do you disagree? Are you seeing something different?
Well, so in our report, there was a deleverage. You can deleverage a couple of ways. You can either default or you can inflate your way out of it. The inflation that we saw under COVID globally has delevered balance sheets a little bit, but there's still a lot of debt out there and a lot of misallocation of resources into bubbles like the AI bubble, the stock market bubble. And when we had the stock market bubble in the late 90s, early 2000s, it didn't destroy the economy. It was just a bubble just bursting, and there was a recession, and then we came out of it pretty strong. But that unfortunately was caused by money printing that went into the real estate sector. So this is I think the idea is to restructure the economy without using financial gimmicks and to do it more like Trump wants to do, which is use trade to get manufacturing back in the U.S. and get jobs, good jobs for the average citizen.
Yeah, and if he has his way and the dollar comes down, that's going to be very bad for, I guess, the rest of the globe. As you said, imports are going to become more expensive. Then it's going to sort of benefit the manufacturers in the US, and it's sort of going to be this. It could work in Trump's favor, but it'll be very bad for the rest of the world.
Well, it depends on the country.
Yeah.
Europe is our biggest trading partner. Europe has the most to lose.
Yeah, definitely. So what does this mean for assets? You've mentioned bonds. I'm guessing sort of precious metals, or cryptos. Do you see them sort of being impacted by this?
Well, look, I'm a math guy, and this is nothing against crypto or Bitcoin. I think I think that asset class has been legitimized and is going to stay. It's very, it's very risky asset class. It's very volatile. Statistically, it's correlated 98% to the NASDAQ 100 in the U.S. So goes the NASDAQ, so goes Bitcoin. So, if you're a Bitcoin bull, you'll have an opportunity to buy a lot. If you are thinking Bitcoin is going to be a hedge against asset price decline, I would tend to argue with that. The safest security in any kind of recession or asset repricing is the U.S. Treasury T-bill market. 3-month T-bills, 1-month T-bills.
Yep. No, definitely makes sense. And then I guess what would you have to see for you then to sort of shift back to risk on?
Well, usually our economic early cycle indicators will start to turn up before it's apparent to everybody, and usually it's a second derivative change, right? It can't get any worse. I'll use an example of a company that back during the great financial crisis, NVIDIA, which is a big stock now, but back then it wasn't an AI stock. NVIDIA was a $2.50 stock. They reported, this was in March of 2009, they reported minus 50% revenues, and the stock didn't go down. And so I said to myself, wow, it didn't go down. How much worse could it get? So we'll make our call when it's so bad, the second derivative can go nowhere but up. That's usually when everybody else is at the bottom selling. So we'll follow our early cycle indicators. We'll make the call, and we might make the call a little early, but we'll make the call.
Yeah, no, that's really interesting. As you're saying, is when the bad news comes and it doesn't go down, and it's the opposite. When the good news comes and it doesn't go up, then that's the risk as well.
Yeah,
from that side of things.
Anthony, you know this. Market's top
Yeah.
on good news, bottom on bad.
Yeah, exactly. Seen that with crypto with Trump coming in and it's come down however much since then. But yeah, Edward, thanks so much for coming on. Really appreciate it. We've sort of gone in all different directions. But my last question is, what is one message you want people to take away from our conversation?
Yeah, so don't just prepare. Don't panic. Lots of opportunities coming if you're prepared. We're selling an U.S. economic report, Dangers of a Deep Worldwide Recession. The target audience is mostly institutional, registered investment advisors, family offices, C-suite executives, high net worth individuals. If you're interested, it's on our website, financetechnologies.com, spelled with a PH. And if you can't afford it, you can kind of cipher what I said from this and understand that the safest thing to do is to go to cash, or at least put a large part of your portfolio in cash.
Yep, great and important message. So thanks again. So yep, I'll put the website down below. Is there anywhere else, X or anywhere else people can find anything?
Yeah, so I'm on X at Dowd, Edward, DOWD, Edward. I post often, and I'm also on Getter at Edward Dowd. And we have a lot of free resources on our website. If you don't want to buy the report, there's lots of interesting pieces we've written and put out.
Perfect. I'll put it all in the description below. So thanks again for your time.
Thank you, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.